Welcome back, folks. This is Travis with T-Call Fitness, and we are back for another session. We're going to talk about the fiscal cliff. This has been the hot topic in the media news for the past couple of days, being that our elected officials in Congress have decided to play circus again, and at the end of another year, 2012, as they battled it out on the floor, talking about taxes, whether to increase them or not to increase them. So we're going to go through some of the details of what was actually passed. So first, the House sent a bill to the Senate, and then our colleagues in the Senate made some amendments and then sent it back to the House for a vote. And the House came out late yesterday evening, or I believe it was Tuesday evening, and they voted 257 in favor of the amendments made by the Senate and 167 not in favor. So larger number wins, of course. So there are some changes that are going to take place for 2013, and also some provisions that expired in 2011 that are extended into 2013, and some things are being extended through 2018. So let's take a look and see what those are. Individual tax rates. Those will continue from the 2001 and 2003 rates of 10%, 15%, 25%, 28%, 33%, and 35%. So Congress has added another tax bracket of 39.6%. For single filers who have income greater than $400,000, head of household filers with incomes greater than $425,000, and joint filers with incomes greater than $450,000. So if you followed the news at all, President Obama would have preferred that the $400,000 level be reduced down to $200,000 for single filers, or $250,000 for joint filers. So the negotiations increased those amounts to the $400,000 and $450,000 levels. Looking at itemized deductions and personal exemptions, these will phase out for single filers who have more than $250,000 of income. Head of household filers $275,000, and the threshold at $300,000 for joint filers. Let's look at capital gains. Capital gains and qualified dividends. The rates will go from 15% and revert back to the original 20% rate. If you have ordinary dividends, however, those will continue to be taxed at your tax bracket rate. So if you have income of $400,000, and you add on to that your ordinary dividends, then each dollar of ordinary dividend will be taxed at the 39.6% rate. Alternative minimum tax. This is the hairy tax. Oh yes. This tax was originally implemented so that rich people back in the day, many years ago, could not implement certain loopholes and avoid paying their fair share of taxes. But in recent years, because Congress has neglected to index this particular exemption, every year or every 2 years or every combination of years, we've always had to deal with whether Congress was going to patch the AMT. We called it the AMT patch for a number of years. So finally, Congress put some sense into their thinking and have decided with this passed bill to permanently index the alternative minimum tax to inflation. So 2012, joint filers will be able to claim an AMT exemption of $78,750. Single filers will have an exemption of $50,600. Now, if Congress didn't do anything, then the amounts would have reverted back to the original amounts which were for single filers $33,750 and for joint filers $45,000. So you can imagine that millions of people would have been impacted by the AMT if Congress took no action whatsoever. But they have taken action, and they have adjusted and decided to make the AMT subject to, or to index it for inflation. So 2 thumbs up for that move. Estate and gift taxes. They have set the estate and gift tax exclusion amount to $5 million, and they will index that for inflation in future years. And they've increased the top rate from 35% to 40% effective yesterday, January 1st, 2013. Yes, if you have not guessed yet, today is January 2nd, 2013. The current local time here in Provo, Utah is 10:44 p.m. in the evening. And along with these tax rates and other adjustments, there are some permanent extensions. One of those extensions has to do with what is called the marriage penalty. In previous years, a single tax filer claimed a certain amount of standard deduction. Now, when you move or graduate from single filer to a joint filer, you would think that you could just double the standard deduction and be good. But that's not how it was. The standard deduction for joint filers for many years was not twice the single amount, but it was more like 2/3 the single amount. So they have decided to make this particular extension permanent. So now we don't have to play around with this and join the circus every year in December as Congress mulls it out and tries to figure out, oh, what are we going to extend? What are we not going to extend? So this is one that they have tagged to permanently extend. So now the marriage penalty is no longer existent. That will go away permanently. Another one is the dependent care credit rules, the child and dependent care credit rules. So up to $3,000 for one dependent, $6,000 for more than one dependent. So that is permanent now. Another one, let's see, what was I looking at before? Well, I think I was looking at one of the extenders. But anyhow, there were some credits that expired at the end of 2012 that have been extended through 2018, primarily the American Opportunity Tax Credit for qualified tuition and other expenses of higher education are being extended to 2018, and the child tax credit of $1,000 and the earned income tax credit, those will be extended through 2018. And there were some popular provisions that expired at the end of 2011 that will be extended through 2013. These have to do with school teachers and their ability to deduct certain expenses for elementary and secondary education teachers. Another one is the mortgage insurance premiums can be treated as qualified residence interest. Another popular one is the deduction of state and local general sales taxes. This is a benefit for those who live in a state where there is no income tax, and there are 7 states that do not assess an income tax. And you can see the rest of them there. So since my passion is with individual tax, I'm not going to address the business tax extensions here. There were also some energy tax extenders as well. Here you can tell the intent of Congress or the intent of the government is to provide incentives for what you might call new age energy. Green energy is another tagline that they have. Foreign provisions. Since I am also an international tax expert for individuals, this is key to our practice. And the IRS, their authority to withhold certain taxes on gains on dispositions of U.S. property and partnerships, trusts, and estates, and so forth, that pass on to foreign persons, they've made this permanent. And they've increased the amount to 20%. So now there is a mandatory 20% withholding if you are a foreign person with investment in a U.S. property through a partnership, trusts, or estates, and income passes through to you as an investor or as a stockholder or a member of that particular entity, then the U.S. entity is required to withhold 20% federal income tax. So this is a potential area where our services or our business could increase. Because if there are foreign persons who normally would not file a U.S. income tax return, now they would be required to file an income tax return if they wanted to get a refund. Because obviously they might be or should be resident in their home country or the country of where they're living and working, and that country generally taxes worldwide income. So if there's income generated from U.S. sources for that particular individual who is a foreign national, and they must report that income in their home country or their local country, then they would want to avoid double taxation, because the U.S. Generally allows a credit of foreign taxes paid against U.S. taxes, or vice versa. If the U.S. feels that they have the first right to tax, then that individual will definitely want to claim a tax credit for U.S. taxes paid on the same income that they're reporting in their home country or their local country. So again, potential opportunities for increase in our business, in our practice. Other things, other provisions. So some people have been asking, well, what about the net investment income tax? This extra Medicare tax. Well, remember, that was enacted through the 2010 Obama healthcare provisions, or the healthcare law. So the additional hospital insurance tax on high-income taxpayers, the 0.9% increase above and beyond the 1.45% Medicare tax, is for taxpayers who have income greater than $250,000 if you're a joint filer, or $200,000 if you're a single filer. And the other tax, the Medicare tax on investment income, i.e. the investment or the net investment income tax, this is the additional 3.8% Medicare tax assessed on taxpayers who have income greater than $250,000 if you're a joint filer, or $200,000 if you're a single filer. And there's another item here we can see with the medical care itemized deduction threshold. That's going to go from 7.5% up to 10% unless you're a certain age before the end of the tax year in 2012. So again, a quick look at some of the provisions and things that were included in the bill that just passed through Congress, avoiding the fiscal cliff, if you will. And if you know me, I like to look at things directly from the horse's mouth, and so here is a document from Congress that has been published by the Government Printing Office. You can go to www.gpo.gov if you want to get a copy of this, or you can do a search for the Journal of Accountancy and their Fiscal Cliff article, and at the top of this article there is a link that you can click and get access to this particular document that I just showed you here. And this is the language. So if you're a lawyer, or if you enjoy reading the language, the raw language, if you will, of the law, you can see how their wording is, and you can browse through this document. But I will not bore you to death with those details, even though those details are very interesting to me, and I like to be able to go to the source and get that detail and read it for myself as I have time. So I'm going to sign out, and thanks for joining us today.